Taxes are one of the biggest expenses that retirees can have. Now, what if I told you there was a way you could take long-term capital gains and pay 0% taxes on that? Now, if we look at the capital gains tax rates, these are the long-term capital gains tax rates, you can see how up to almost $50,000 if you're single, you're in the capital gains tax rate of 0%. And it's almost $100K if you're married filing jointly. And note this is taxable income, not gross income, so this is after deductions. But if you're underneath these tax brackets for 2026, you can take out, let's say you have a large gain in a position that you've held for the last 5 to 10 years. You can sell that, and you can actually buy it back immediately, because with a wash sale, that only applies if you're taking a loss. But you can buy it back immediately if you're selling it for a gain. And up to $50,000, as long as your taxable income is under $50,000, you'll pay 0% on that. If you're single, or married filing separately. Now, married filing jointly, it's up to almost $100K. Now, there are a couple things you need to do to implement this strategy. First of all, figure out your taxable income for the year. Calculate Social Security, any pensions, and step 2 is find the gap between that and what the tax bracket would be. For instance, if you're married filing jointly, let's say you have $50,000 in Social Security plus pensions plus short-term capital gains and dividends. Then you can take up to $50,000 in long-term capital gains. Obviously, it's slightly lower than that, but at $98,900 to be precise. You can sell those investments to fill that, and if you want, you can buy them right back, and then rinse and repeat every single year. Now, there are 3 things to watch out for. 1, this is a federal tax strategy. If you have state income taxes, in New Hampshire we don't have those, but if you're in Massachusetts or another state, then that could potentially be an issue. You need to watch out for that. And the second is capital gains can affect other things. For instance, IRMA surcharges. If you have too much in income, potentially your IRMA surcharges will go up. And then the third is these thresholds adjust for inflation every year, and make sure you're using the right threshold for that year. Tax information changes constantly, and there are people who use outdated tax information, and then they look back and it's like, oh, well, the reason we messed up was because we used the information from 2023. So make sure you're using up-to-date information. Make sure that it's not affecting anything else significantly. And also, federal tax strategy, not state tax strategy. You'll have to pay state taxes if you have a state income tax. You'll most likely have to pay state income taxes. If you're interested in working with us, this is really one of the strategies that most commonly it gets used along with Roth conversions, and a litany of other types of ways to minimize taxes. If you're interested in talking to us about that, you can contact us in the description. Thanks for watching.